of Manchester, UK. So before we begin tonight's agenda on the topic about how to make smart investments, so allow me to introduce to you our team from the University of Manchester, Dubai. I am Ronald Sarmiento, Program Counselor, along with my colleague AK, Senior Program Counselor, Pia, one of our Program Counselor as well, and Yusuf from our Marketing Department, and our guest speaker for tonight, Dr Arif Khurshed. Okay, so before we proceed, so allow me to introduce to you about who we are, what we do, and where can we take it. So this is the University of Manchester, Dubai. Let's play and watch a video. Okay, so thank you everyone for coming for tonight's masterclass and sparing some of your time for the Thursday evening. So the University of Manchester is committed to world-class research and outstanding learning and student experience and social responsibility. The University of Manchester is the UK's largest single-site university, and we were established in 1824 and celebrated our bicentennial 200 years of making a difference. Currently, the university is ranked 6th in the UK, 7th in Europe, and 34th globally as per the QS World University Ranking. And in Financial Times 2025, we are ranked 5th in the UK, 14th in Europe, and 46th globally. So we are a triple accredited university with accreditation from AACSB, Association of MBA, and ICWIS. And as of today, only 139 business schools and universities in the world in 36 countries has a Triple Crown accreditation, and that is about 1% of all the business schools and universities in the world. The Association of MBA is an accreditation that certifies the overall quality of our MBA program, including faculty and facilities. The accreditation assures students that the business school adheres to high-quality standards. AACSB and ICWIS include equality benchmarks for the business school. The University of Manchester has a rich academic history. We are now home of the 26 Nobel Prize winners from 1906 till 2024, where awards given to physics, chemistry, economic sciences, and medicine. So the University of Manchester in Dubai was established in 2006. Currently, we are celebrating our 19th year, and next year will be our 2 decades of existence here in the Middle East region. And we are proud to say that the University of Manchester, Dubai has now licensed by the Ministry of Higher Education, Scientific Research, and all our programs are now accredited by the Commission for Academic Accreditations here in the UAE. So we have supported around 3,600 plus students in all our master's program with an active regional alumni community of about 5,500 here in the Middle East region, and graduated 2,650 students from all our master's program coming from 107 nationalities. So we have 5 global centers. So we have the one in Dubai, the main campus in Manchester, we have Hong Kong, Shanghai, and Singapore Center. And Dubai is considered as the fastest and the largest center of the University of Manchester Alliance Manchester Business School network, wherein the Alliance Manchester Business School is currently celebrating its 60th year anniversary. So the programs that we offer here in the Dubai University of Manchester are the following. So we have the Manchester Global Part-Time MBA, which is a 2-year program, the Manchester Global Executive MBA for C-level individuals or more on the senior leadership professionals, which you can take it into 18 months or a year and a half. We have the MSc Financial Management program as well, which is a 2-year part-time program where our guest faculty, Dr. Arif Khurshed, is one of the teaching faculty in finance as well. So MA Educational Leadership in Practice for educators working in the education sector, like teachers, principals, and other academics who wish to move their career into a senior or leadership role. And the last one will be our executive education. These are our short business courses that you can usually 4 to 5 day courses where you can attend physically in the main campus of the University of Manchester, UK. Let's move on. So as I've said, the executive education, these are all courses designed for managers, leaders, and working professionals like you. Face-to-face delivery over 4 or 5 consecutive days in Manchester, UK. Taken individually, 4 courses will result in a Manchester Professional Diploma in Leadership. And after completing every courses, you'll be receiving professional certificate from the university with a digital badge as well. So price range is our 3,990 British pounds for 4 days, or maximum 5 days, which is 4,990. So these are the example courses that you can currently dated that will be happening starting in May. So we have leading ESG, sustainability, leading major projects, digital marketing essentials. So those who are interested like you, especially our alumni and students graduated into our program, just scan the QR code, meet us after the event so that we can discuss further. And if you are interested in any of our programs as well, please do let us know and we'll be happy to assist. Okay. So allow me to introduce to you our guest speaker for today. Okay. So Dr. Arif Khurshed is a professor of finance and incoming program director for MSc Financial Management at the University of Manchester. He earned his PhD from the ICMA Center, University of Leading, and is an expert in corporate finance, focusing on IPOs, venture capital, and private debt. Author of The Mechanics and Performance of Initial Public Offerings, he has supervised over 20 PhD students and received multiple teaching awards. He serves on editorial boards, has held key academic leadership roles, and advises organizations like the FCA, BVCA, and IVSC, while also contributing to media and legal cases as a finance expert. So welcome, Dr. Arif Khurshed.
Thank you, Ronald, and everyone very much listening to you. In today's session, I promise I'll not make you rich, but hopefully I'll set you on a path where you can decide how to get rich because information is the power, isn't it? So I would usually ask the question, before you teach anything to us, sir, can you tell us how much money you have made yourself by, practicing what you teach? And I can assure you, I haven't made much. And I'll tell you the reason for that, because right now, in UAE, in special, there's something happening which, according to me, is enormous. And this is something I'll talk to you about today. It is the world of initial public offerings. So what is an IPO? Why is it an interesting investment opportunity? And for the last, I would say, 25, 26 years, in my research, what I've learned, I'll share with you. And I feel very excited that we are in a very interesting time as we speak, especially in the Middle East. So today I'll share with you some insights from my own research and my understanding of this world. The important thing is that we are critical in our thinking, that we understand and we are able to process information, and then we are free to make our decisions of where we would like to invest and how. So today, what I'll do is I'll speak to you about one particular investment opportunity when a company decides to sell shares to new investors for the very first time. So before we do that, there's a little exercise I would like you to participate, if you could please. Can we have the Mentimeter slide, please? So I would request everyone with a smartphone, if you could log on to a website called Menti. So if you can just go to the slide, please. I promise you it's going to be a short exercise, but it'll tell us where we stand. So this is the, we need to go to the website where the Menti is. I think it's already open.
Yeah. We need to share, we need to know. So
yes, I'm going to give you the code exactly, yes. The slide should give you the code.
Just wait a minute.
Okay, so maybe you just click on present on the top right, please. This is a question for all of you. So if you go to menti.com, as you can see at the top, menti.com, it'll ask you for a code, and this is the code you can use, 625 40175. And then I would like you to answer this question for me. How familiar are you with the world of initial public offerings? And let's see where we stand as a group today. Okay, so it looks like we have a very knowledgeable audience, which is great because maybe you can share your insight. Because the next question is, if you go to the next slide, please, have you ever invested in IPOs, either in UAE or anywhere else in the world? Wonderful. So we've got a sizable number of people who have invested in IPOs. Maybe I can share with you, or you can share with me the experience after the presentation. But today what I want to do with you is to take you to this investment opportunity and try to understand this more academically to see exactly why companies do an IPO, and ask potential investors, what should we be looking for if we do decide to apply for shares in companies that are coming to the stock market for the very first time. So we'll go back to the main presentation, please. Okay, so I have got the clicker here, so I can now take on. So very quickly for the agenda, I'll quickly talk about understanding the world of initial public offerings, and after that, a short discussion on how do companies prepare for an IPO, why do they do an IPO in the first instance, what is the regulatory landscape when it comes to the UAE IPOs, a quick market overview, what has been happening in the last 2 or 3 years, and what are the forecasts for the coming year and in future. And then finally, talking about how do we make investment decisions when we look into IPOs as an asset class. And finally, what are the risks and considerations when making a decision? And then there will be an opportunity towards the end for a Q&A, so feel free. In fact, you can stop me while I am presenting if you have a question. I'm happy to take questions as we go along. So, in terms of the world of IPOs, an IPO is the process by which a private company decides to go to the stock exchange, and in the process, the company sells its shares to new investors for the very first time, and hence initial public offering. It is a very important stage in a company's life cycle, in the sense, not all companies will do an IPO, not all companies will be allowed to do an IPO because there is a regulatory setup. You have to satisfy the regulations of the stock exchange before you're allowed to do so. And it's not beneficial for every company to actually even go for the IPO because there are alternatives available. So when a company decides to do an IPO, it has to go through a process. So what is that process? The process is what I'll explain to you in a few minutes. It is not only private companies that conduct an IPO, governments also conduct an IPO. And these are what are called privatization IPOs. And we have a number of examples in UAE. For example, ADNOC did an IPO a few years ago. It is, or it was, or still is, owned by the government as a majority stakeholder. DIBA in Dubai did an IPO. Salik did an IPO. Mastar is on the verge, and so on and so forth. So governments also sell a stake to investors like you and me through the process of listing the company on the stock exchange. And sometimes we have a different pathway to go to the stock exchange, something that is called a direct listing. So in a direct listing, the company short circuits the whole IPO preparation process. They are in a negotiation with the stock exchange in terms of the valuation. The stock exchange and the company decides on the price, and the next morning, after all the regulatory clearances, the company starts to trade on the stock exchange. So if you want to buy shares in the company, it's not an offer, you have to buy it in the open market. So we have different ways in which companies can access stock markets, and IPO is the most common one. Why would a company conduct an IPO? So if you look at the documentation that is produced at the time of the IPO, which is a prospectus, companies talk to you about the reason why they want to do an IPO. And the most common reason is we are conducting an IPO because we need capital to grow the company. Also, companies raise capital to pay off debt. So imagine you and I set up a firm many years ago and we borrowed some money from a bank and we are paying very high rates of interest on this. And some of the money that we can raise through the IPO can be used to repay all debt. So in a way, IPO provides the opportunity to restructure the capital structure. So if there's too much debt, and in fact we teach you about debt, you can come and study with us in the MBA or the MSc Financial Management program. And one way in which you can rebalance your sheet is by using your equity to pay off all debt. Also increases the public profile of the company because the company is now in limelight, the media has picked up, Financial Times talks about it. So it is seen as a good thing in terms of free advertising, but of course, the transparency required at the time and beyond the IPO would also be seen as a disadvantage of doing an IPO. One of the important reasons for a company to conduct an IPO is for the original shareholders, the owners of the company, to have a chance to sell some or all of their stake and get the cash. So it is an opportunity to provide liquidity for the original shareholders. And for us as investors, it is an opportunity for some potential in early gains. So where do these early gains come from? This is something I will pick up on in a few minutes. And as an investor who is rational and understands the importance of diversification, IPO could be an interesting asset class. So from an investor's point of view, looking into the world of IPOs gives us an opportunity to understand different classes of investments. And we may decide to invest in an IPO for reasons that I will just explain in a few minutes. How do companies prepare for an IPO? It's a very intense process. And over the years, as a researcher, I have been involved in consulting companies. Many of them went on to become very successful in the world of IPOs. The most recent case is Nahdi Pharmacy, a Saudi firm, a chain of pharmacies, the largest, I think, in Middle East. They conducted a successful IPO, I think, 3 years ago, and I was a consultant to the company where I spoke to the board of directors and the finance department, explaining this whole process of how do you prepare, how do you negotiate, how do you do valuation of the IPO, and so on. So it takes a lot of time for a company to prepare for an IPO, sometimes as long as 1, maybe 2 years. So once a company decides that this is the way forward, the very first thing they have to do is to hire a set of advisors, because this is the legal requirement. And the most important advisor is the underwriter, also called the sponsor to the IPO, which is usually an investment bank. So the company approaches an investment bank, or it could be the other way around. There's a whole process as to how we find the right partners. There's a lot of science behind it as well. For example, if you are a company planning an IPO, you want to approach someone, some bank, that has expertise in your industry, that has a pedigree and a background and a history of successful IPOs coming to the market. But then if it's a good quality bank, the fee they will charge you is also going to be high. So you have to find that right balance between good quality and the cost of doing the IPO. But this is where you start as a company, the appointment of advisors. The advisors will give you a lot of advice in terms of the paperwork that is needed to prepare the company for an IPO. The stock exchange does not talk to the company directly. It goes through the intermediary, which is your sponsor. The sponsor's duty is to do the due diligence, to provide legal advice through the legal advisors, to prepare a document called the IPO prospectus. So IPO prospectus is a document, it's like a book, which talks to you about the history of the company, its plan for futures, why it is conducting an IPO, and so on and so forth. And this document is published about 3 or 4 weeks before the company hits the stock market. So the publication of IPO prospectus is a very important milestone in the process of preparation. And this is the time when you and I get to notice that this company is doing an IPO for sure. But there could be a lot of rumors in the market about the company planning and so on. But when an IPO prospectus is published and made public, that is the time when we know that this company is on the path to conduct an IPO. Because in the prospectus, there will be a lot of information. There will be dates. For example, when can you apply for shares? What is the deadline when the application will close? And there's also an indication of what would be the first day of listing on the stock market. So the publication then kickstarts the process. Around the time of the publication of the prospectus, the company will announce what is called a subscription period. Now, what is happening currently in UAE is that almost all the IPOs are providing an opportunity for small investors to invest in the IPO. So they call it the retail tranche. So the company might say, we have got 3 tranches, a retail tranche, an institutional tranche, and maybe the company has reserved some shares for the employees. So this is the 3rd tranche. So you can read about all of this in the IPO prospectus, which will also tell you that applications open on this date, they close on this date. Usually the time period is about a week or so. And it also tells you what is the minimum amount you need to bid for in terms of either shares or dollar or AED, which would make a minimum application. So all this information is effortlessly, free of cost, available through the IPO prospectus that you can download from the company's website, or you can download from the stock exchange's website as well. So it is very easy relatively now to get information on the company planning an IPO. The important thing is about the pricing of the IPO, because this is where everyone is watching. You as an investor, the company as an issuer. Because this is where it all comes to, right? If the company prices at very high price, maybe there will be insufficient demand for shares and the IPO goes nowhere. If the company underprices, then they lose a lot of money on the table, because if I could sell something for a dirham and I sell it for 50 fils, I'm losing half of my amount for every share I am selling. How do you find that right balance? It is a science, it is also an art as well. And this is where the company gets a lot of advice from their underwriter, because they are specialists in valuing companies. So what companies do these days is quite interesting actually. If you go back to sort of late 1990s around the world, companies used to price their IPO shares with the help of the underwriter. And then in the announcement, in the prospectus, the announcement would be, we are selling our shares at 2 dirhams and 50 fils per share. If you like it, apply. If you don't, leave it. This is called a fixed price offer. But then something changed in sort of early 1990s in the US. And what happened was, these valuators who were helping to value an IPO firm, they said, you know what, why should we do all the work ourselves? We should also invite the market to have an input in the pricing. So what happened was, rather than giving a fixed price to the world, the company started saying, you know what, we think we will price our shares somewhere between 3 dirhams and 5 dirhams. They gave a range of price. And then what they do is, they do what is called book building. So once this price range is announced, at the time of the publication of the prospectus, the company and the advisors then do a roadshow. They go from Abu Dhabi to Dubai to Sharjah to other countries that they're selling globally, and they present their case to investors in meetings like these. And after the presentation, the company will take orders from the audience. How many shares are you going to buy at what price? And they build a book. And hence we call it book building. So at the end of the book building, the company sees, I can sell all my shares and this is the highest price I'm going to get. And that then becomes the offer price. So it was a very nice way of engaging with the market, because in the end, I could be a top quality company, but if you don't think so as an investor, you will not buy my shares. So this idea is embedded in the pricing of IPOs in UAE as we speak. And I feel this is a fair way to sort of gain participation from people who will eventually end up buying shares in the company. So all this process of pricing is happening after the announcement of the subscription period. At the end of the subscription period, after the book has been built, the company then announces the final offer price is X, and everyone who applied for shares without knowing the final price, if their application price is at or above, they are the ones who get allocation. So once that allocation happens after the pricing, then comes the listing date. So all of this pricing and allocation and listing usually happens about in 3 or 4 days' time. So if tomorrow morning the company starts to trade, maybe tonight you'll receive a text message congratulating you that you have been successful in subscribing to X number of shares from the application that you made a couple of weeks ago. So that is the usual process that we are using currently in UAE. In terms of the regulation, because this is where you would be very interested to see what is the role of the regulator. As a small investor, we have a problem with information. We don't know about this company because it was a private firm. The company perhaps never presented their financial statements before. We don't know what are the intentions of the firm. We don't know what is the future of the firm. So there's a lot of information asymmetry between the company and potential investors. This is where the regulator plays a very important role. And in my opinion, as a researcher, the UAE regulator has done a tremendous job in trying to bring transparency and attracting small investors like you and me to participate in this asset class. In the UAE, as we all know, we've got 3 stock exchanges. So we have one here, the ADX, the Abu Dhabi Securities Exchange. We've got Dubai Financial Market. These are the 2 onshore stock exchanges. We also have Nasdaq Dubai, which is of course an extension of Nasdaq US. So most of the IPOs in UAE take place in the top 2. All of this activity is regulated by the national regulator, which is the SCA, the Securities and Commodities Authority. They set out the rules and the regulations of who will be allowed to do an IPO. There are certain norms that have to be satisfied by the company before it is given a yes on the process. And not all companies make it. And regulator does not stop after the IPO. Actually, they carry on. Their role is to monitor the compliance in the post-IPO period as well. And the whole idea is to protect the small investor. And also to attract international investors who would see UAE, for example, as a stable market where rule of law is followed and that small investors are protected. So all of this is also a showcase to the world that you're investing in a market that goes by the rules and regulations of the land. To give you a quick overview of the IPO market that we've had after the COVID crisis. So if I look back from 2022 to 24, it has been a very strong 3-year period for IPOs in UAE. At an average, we've had about 8 to 10 IPOs every year, which is unseen in UAE in the past. Almost 95 billion AED have been raised in out of these 2022 IPOs that have taken place in the last 3 years. It all started in 2022, where there was a significant surge in IPO activity in UAE. This was the time when privatization IPOs like DIBA came to the market, and they created a lot of buzz in the market, and we will have some discussion on that in a few minutes. 2023, almost half of all the money raised in the whole of the region was through the IPOs in UAE. Mind you, Saudi is the largest market in the Middle East, but then we give them a lot of competition in terms of the amount of money that they raise, even fewer IPOs in UAE. And the dominance of UAE continued in 2024 when we had, I think, 8 or 9 IPOs last year. So if I run you through some household names for us here in the UAE, but before we do that, this is what happened since 2022. Diverse firms such as Baroge or Burjeel Holdings, DIBA did an IPO. This was a privatization. It raised $6.1 billion. Salik did the IPO as well. It was a privatization. Admiral was a privatization. Talim, educational sector, and so on. Again, here you can see a number of firms. Pure Health, Spinneys was a privatization, an IPO of a private firm. Talabat, December 2024, was an IPO of a private firm. And this year we have Alpha Data here, ADX, as the very first IPO of 2025. So we've had a number of IPOs. And I say this because having followed other markets as I speak, something like this is not happening in London. Something like this is not happening in New York, because we have to also take into account the size of the markets, right? So this is a fledgling market, a small market. The activity is just humongous, in my opinion. If I take you back to 2022, this is where it started as a privatization. So DIBA did an IPO in April of 2022. 9 billion shares were offered to the public at a price of 2.48, and the demand was very high, 37 times oversubscribed. What it means is, for every 1 share being sold in the IPO, the demand was for 37 shares. So that takes us to the next thing, how are shares allocated? And this is where companies usually have a lot of say as to whom they would like to allocate the shares to and whom not. The price rate was 2.25 to 2.48, and the company decided to have the final offer price at the top end of the range. That gives you a signal that there's a lot of demand for shares. Because as a small investor, you and I are looking for signals of quality. So how do we figure out what is a good quality IPO and what is not a good quality IPO? A difficult thing to do. But we look for signs of quality. If during the book building process, you get this idea that there's a huge demand, and then you hear that there was oversubscription, it gives you a sense that there was a huge demand for this, which means other investors have been equally interested in this firm as you are. And this is where we have a lot of problem in the world of IPOs. The problem is how other people are responding in terms of their applications is usually not discussed in media or by the companies around the world, except in few countries. So in my role as a researcher for the last 27, 28 years in IPOs, my struggle has been, and I have consulted regulators in London and Milan and Mumbai and so on, my struggle has been, this is a very important piece of information for small investors like you and me. How is the book being built? How did the price was arrived at? How the allocation is being done? why not tell the world how this is happening behind the closed doors? There's one market, in my experience, India, where the regulator has gone way, way ahead of what I expected it to do. In India, when the book is being built, that subscription period, the book is shown live on the internet. And it is updated every 30 minutes of the book building period. So what is the importance of that? I'm a small investor with 1,000 dirhams in my pocket. I would like to invest, for example. I don't know, I'm not able to distinguish between good and bad quality IPOs. One thing I could do is to log onto the stock exchange website, and if the book building is being shown live, I can see who is applying for shares. Not the names, of course, but the type of investors. Institutional investors, high net worth individuals, and so on. And that demand is shown live, and that gives me confidence that institutional investors are applying early in the process. That could mean that this is good quality. Why? Because institutions do a lot of research before they apply, because they apply in bulk. So they do all these valuation techniques, and then they take an action. Because when you apply for shares, it is a binding agreement. It's not as if you say, sorry, I applied for 10,000 shares, but I've changed my mind. It doesn't work like that. So you apply after you've done your research, and that signal could be seen by you and me, and then we can decide yes or no. In fact, I wrote a paper a few years ago because I got all this data. And my hypothesis was small investors should be watching the behavior of large investors as the book is being built. And my expectation was on the last day, they should be revealing their true demand. And this is exactly what we found in our data. In the last 2 hours of the book, small investors put all their orders because they are trying to learn from the behavior of the investment of large investors. And they can see that on the book. So, but we have to operate in the systems we operate in. This kind of information is not made public in UAE or for London, for that matter, or New York. But that is where we have this importance. You have a question?
So the question is reflection, because I have tried this IPO.
Yes.
I got, let's say, 100,000 dirhams.
Yes.
Because of oversubscription. What is allocated to me is only 4,000 dirhams.
Exactly.
So it's useless.
Yeah.
I've tried two times and the same results.
Indeed, because many other people are trying it, and this is one of the risks here, because it is so hot a market that there is a lot of oversubscription, and that then brings down the number of shares they are allocated, because there's a minimum, and then there's a pro rata after that, so you may end up getting only a fifth of what you applied for. Yes.
Basically, we try a job which is a free float. Free float is very less compared to the other part of the world.
Yes.
If you are putting the pay for 1%,
So, but this is what is happening in UAE. For the number of shares being offered is usually a small proportion of all the shares in circulation. We call this free float. For example, in London, by law, the free float has to be a minimum of 25%. It is not true, this is not required here in UAE. It could be as low as 5 maybe 7% sometimes, right? So yes, we are different here in UAE for that matter, and that brings in the problem. If a lot of people are applying, then what is my chance of getting an allocation? So this is one of the risks that I will talk about towards the end. You have to be, you have to be knowledgeable about that. There's nothing you could do. You apply with best of intentions. In the end, you will come to know if you get full allocation or you get half of it. And that is one of the risks of applying for shares in the world of IPOs. I completely agree on that. Yes.
From the list of the IPOs that
Yes.
you shared with us, I checked it is and I checked the deal.
Yes.
So the deal was IPO in 2022 and the Louis 2024. And I saw, so in March, the stock for Dewa was 2.81, right? And in December, it was 2.28. It sharply declined.
True.
The same thing happened. So like from month 4 to month 12, within 8 months, it declined up.
Yeah.
Then the same thing happened, although it's a different year already. 2024 happened with Lulu. So why? Based on my long time years,
Yeah.
Knowledge of classes about the IPOs, it was in 2008, right? When during the global
DFM,
crisis,
yes.
yeah, our professors, like we have like the top professors, and they told us like, don't go into IPOs. Immediately after IPO, your stock, your price will decline within like a time lag of like few months.
Yeah.
Then why, as retail investors, we have to bear the cost of the decline of
Exactly.
price, right?
And
Why
this
don't
is-
financial institutions take this pressure?
This is what I'll talk about in just a few minutes. Exactly what you're talking about is what we see around the world. And I'm going to come to that eventually in a few minutes' time. So I'll answer that question if it's okay at that point of time. Is that okay? Yes.
If you go back one slide, previously, where you pictured
22?
the, action just in the one more.
Yeah.
One more. Yeah. I understand there is Abu Dhabi Global Financial Management.
But that's not an exchange, but that's not a securities exchange where we list the securities. That's the ADGM, so that's a global market, it's like a financial center, you can call it, so yeah, similar to BFC, yeah.
Yeah, so these are sort of broad entities, but this is where everything happens. And the SCA is the one that looks after it. So we have only 3 places where you can actually do your IPOs in UAE, and they are mentioned here. NASDAQ, I think, has had only 1 or 2, if I'm not wrong. But all the activities in either DFM or ADX. The first IPO in this year was at ADX. Okay. I'll continue.
Okay, so we need to know like the companies that have been listed, been done like an IPO for 22, or I mean like we are around 30 companies, right? How many of them they have achieved like an annual growth in the stock price, let's say more than 10%, 15%?
I'm just going to do that, actually, but that is the next interesting thing about the world of IPOs. I'll talk about short performance and long performance after the IPO, because we need to know, and you rightly said, why should we bear the cost of a falling share price in the long run as a retail investor? Why shouldn't anyone else do it? In fact, no one should be bearing that cost. But there is a cost, that is the first thing we will establish. What are the reasons? Something we'll talk about at that time as well. So just allow me 10 minutes and we'll come to that point for sure. Gentlemen at the back, you had a question.
Yeah, so my question is regarding the price that is set.
Yeah.
So they went to the process of popularly with the market.
Yes.
We got an idea about the price which they're going to be fixing the market.
Yeah.
They fix the price at 2.4. I'm sure they would have had an idea that this is going to be the security. So that's a huge number.
Yeah.
So they would have had 2 options. One option is to charge premium to the customers instead of the number of investors.
Yes.
Maybe 2, so 2.4, they could have 12.4, still sold the shares, right?
Yes.
Or they could have limited the number of shares with which they were going out of the market. How did this strike the balance?
Yeah. So what we're talking about here is this mix of how many shares and what price kind of question that all companies would have to face at some point of time. And this is what is decided between the company and the sponsor at the time of preparing for the IPO. So what will happen is, once your company says, I am on the path of preparing for an IPO, the decision has been made, you sit down with your sponsor, and the very first question they will ask you is, why do you want to do an IPO? How much money do you want to raise as a company, and for what purpose? So the company has to be very clear. I'm doing an IPO because I want the initial shareholders to exit, get the cash, and maybe leave the company, or partly leave the company. Or I'm doing the IPO because I want to raise capital so that I can do my ongoing projects. So I want to grow the company, and therefore I need the capital. Based on this need, the advisor will give you advice on the mix between primary and secondary shares, we call it. So primary shares are newly created shares that are sold in the IPO, and the proceeds go to the bank account of the company. Secondary shares are sold by the original shareholders of the company, and the proceeds go to their pocket. So first of all, you have to decide on a mix of primary and secondary. Secondly, because there are implications on the pricing and the money collected, sometimes companies have to change their structure, their memorandum of understanding and existence. So imagine all of us started a company and we've got 1 share each, and we want to do an IPO in the next 6 months. We will, through legal procedure, convert 1 share each to maybe 10,000 shares each, right? Equal equity. and then we decide how many of these shares will be sold. So basically, you do a lot of sensitivity analysis. When I say you, I mean your sponsor will do it for you. Say, okay, if you sell 1 billion at this price, the amount of shares left with the insiders is this much, and this is the amount of money raised. So this balance is done asking or taking the company into confidence, because it has got implications on ownership structure as well. So in fact, later on, I'll show you, I've written a book on IPOs, which you may want to have a read of. There's a whole chapter on valuation, and I've taken an example where I have answered this question. How do you decide? Once you know how much money you need, actually you can reverse engineer how many shares you can sell at the highest price to get this money. Because the idea would be, you want to sell the minimum number of shares for the maximum price possible, isn't it? So that balance is through negotiation between the company and the sponsor. The sponsor has a good idea of the pulse of the market. So they can understand what the valuation multiples are, they can understand what the demand is likely to be. This is where, some companies would hesitate to price at sort of 10 dirhams rather than 2 dirhams. So all of this is into consideration at the time of preparing for the IPO.
Sorry, sponsor can be a syndicate or like
Yes,
only one?
exactly. Sponsors could be multiple, so there could be a syndicate of banks, especially bigger IPOs, hire more than one underwriter to do the IPO for them. And the reason is, maybe it is beyond the capacity of a single sponsor to find buyers for millions of shares. So what you will have is a main sponsor, and then underneath them, they will have a whole syndicate of smaller banks. They put their efforts collectively. They also share the risk of unsold shares collectively as well. So yes, it's very common to find syndicates of writers.
What portion of the shares that they will save, they kind of like guarantee that it will be like, they guarantee by their own capital?
Okay, so what we're talking about is the relationship between the company and the underwriter, because there's always a risk that there will be insufficient demand in the market. So what would happen to a company that has announced an IPO? In the announcement, they said we're selling X million shares. By the deadline, all these shares could not be sold, for example, right? If this happens, the IPO is withdrawn, because the deal with the regulator is either the company sells all the shares they have announced, or they're going nowhere. So there's always a risk, and no one knows what the risk would be till you arrive at that point. This is where your contract as a company with your sponsor plays a very important role. So it might be true here in UAE, but I don't know firsthand on this. But in London, what happens is there are two types of contracts a company can have with their sponsor. One is called a placing, the other one is called an offer for sale. In an offer for sale, the legal contract between the company and the sponsor is, if any shares remain unsold by the deadline of applications, all the unsold shares will have to be bought by the sponsor at the offer price using their own money. So all the risk is with the sponsor in that case.
Usually, like they pay for it, like I don't know, like maybe like 5%. How much they take?
It is usually between 2 to 7% of the money raised.
Can you imagine, like, so they whatever like they earn is just 5 to 7%, but the potential risk is almost
They price the risk in their asking price, in fact.
quite huge.
Yeah, yes. So that is where the quality of the underwriter is important.
Yeah.
Top investment banks have the channels and the network, the expertise to find buyers, right? But they come at a higher price. The fee they charge is very large.
What is the average?
As I said, about 7-8% sometimes. For smaller IPOs, it could be as high as 15% of the amount of money raised in the IPO. So it is it's economies of scale usually.
If you see this market compared to other market, probably valuation is not critical in this market. But we understand this absolutely, because the demand and supply and fixed float is a critical aspect of which we learned from last couple of years.
Yeah.
Valuation is not critical. Valuation is, if there is a good valuation, but demand is not there, the market has fallen down. It is probably looks like a free float availability of share in the market, because there is no share availability is less.
Yes.
So the trading is very less. And trading is less, that anybody can go up and down, say like that.
Yeah. So what we're actually saying is that it is not a very simple process to price, sell, and everything falls in place. There are so many opposing forces. For example, timing When do you actually bring your company to the market is extremely important. You've done your homework, you've done good valuation, you've got everything ready. If some macro event happens, all of this goes out of the window, right? So for example, imagine all the companies that were in the pipeline, and this was October, November 2019. No one knew COVID was around the corner. So when the time came, the markets collapsed completely and everything had to come to a standstill. So timing, if you were a bunch of companies looking into IPO, my pitch would have been different. How do you prepare for an IPO? But we are investors, so we are looking from the other side of the fence. But yes, these are the considerations for the company as to when to bring the IPO to the market, right? And something happens that is beyond their control, it will have an impact on the valuation, the demand, supply, everything is affected at the same time. This was very true. So there's a lot of risk in this, and you can sometimes capture this risk by having a special contract with the underwriting.
How do we increase the total share capital of our company before like you have seen like it's been 1 share into that? How do you do that?
It is, you know, you're free to do this. You can create 1 million shares out of one, you can create 10,000 shares. What will happen is, see, the size of the cake is still the same, the assets. The pieces of the cake then become smaller and smaller if you have this divided into millions of shares. So you could have smaller number of shares, but the price per share will then be high. So it's entirely up to you as to how you want to do this. You get some advice from your legal team, which is a part of your underwriting syndicate as well. So you get all this as a company advice, and then you can decide, you know, what makes more sense. For many entrepreneurs who want to keep control of the company after the IPO, they may decide to create fewer shares, sometimes different types of shares. Like in Facebook, A shares and B shares were created because Mark Zuckerberg wanted to keep control of the firm. So he sold shares with fewer voting rights. All of this is legal advice, and you'll get it as a company at the time of preparing for the IPO. Okay, so coming to, this is where we were with Diva, and price at the high end, 2.48. Subscription period was about 6 or 8 days, March, early April. Allocation is done very nicely here in the UAE. You get a text message, maybe a night before the trading starts, saying that you have been allocated shares or not, or how many shares. The first day of trading was 12th of April, and the closing price, as you were rightly picked up on the first day, was 2.87, which meant that if you bought shares at 2.48 and you sold them on the first day, you were richer gross by 16%. Okay? This is, in the language of IPOs, called underpricing, and this is a very common phenomenon all around the world. And this is what makes IPO world for investors quite interesting. So that was Diva 2022. Next year, Pure Health did a very large IPO, 1.1 billion shares were sold, 483 times oversubscribed. Pure Health was heavily involved in the COVID efforts in UAE when the time came. So they had a lot of background, they had a lot of following, they had infrastructure in place, plans for future. So the demand was extremely high in this case. But an interesting fact about Pure Health was they did not do book building. So what they did was, the company along with the sponsor, they did the valuation in-house, and they announced to the world, we are selling shares at 3.26 per share. If you like it, apply. If you don't, you don't. And you see, retail tranche was subscribed by nearly 500 times. And there is rumor that within the first hour of the first day of subscription, all the shares have been applied.
There's one more factor, is the who's behind the company. So this was under the ownership of Mubadala. So Mubadala was one of the investors in this company.
I see.
So anything which Mubadala is involved, you will see right now.
So was it a cornerstone investor in that case?
Yes.
Okay, so these are big investors. I'll come to that in a minute. And look at what happened to the first day price of Pure Health. It jumped by 76%. So that was a huge return by any measurement. One last example before we move on is something much closer to today. December 2024, Talabat came to the market and they had a very different performance. So they sold even larger number of shares, 3.49 billion at 1.60. There was oversubscription, high end. This is a subscription period. On the first day, the share price actually dropped from 1.60 to 1.49, which is about 7% drop on the offer price. So it could also go the other way as well, okay? So what is so interesting about IPO investments? What we have seen with these few examples is...
My question is that what's the reason you invested?
Okay, so that takes me to a different world. Yeah.
Companies, government companies, they, I mean, basically, they have done what things. The private players like Talaba or like this,
Space, yeah.
they perform not that well because people are still believing that if the government organization is still having at least sustainable price, and of course you have dividend also.
Yes.
When it comes to private player, must be not be that.
Okay, so this is basically the distinction between privatization IPOs and public or private company IPOs, a distinction between the two. But in terms of why the price jumps on the first day, this has kept us researchers busy for last 40 years in the history of IPO research. A number of explanations have been given over a period of time. The most common explanation is something we were discussing earlier, risk aversion from the underwriter. So the sponsor knows there is a risk that all shares will not be sold, right? They don't want to take the risk of buying unsold shares at the end of the subscription. So in order to away from that risk, what they do is, at the start itself, they underprice, because when you sell your product at a lower price, there's a high chance of selling it as compared to when you price it at a higher end. So it could be a risk story. That is how it all started initially. And many big companies face the risk of undersubscription. In my own experience as a researcher, and this is about 20 years ago, I was writing a paper on this risk of having a failed IPO. So, when we publish papers, it goes through a whole process in a journal. It could sometimes take 3-4 years and so on. So I got a report from the referee saying, okay, you're talking about the risk of having a failed IPO. Can you give me examples where this is really applicable? So I did research and I found something closer to University of Manchester, which is Manchester United Football Club, did an IPO in early 1990s, and half of the shares in the club could not be sold by the deadline. So a club as famous as Man United, yet undersubscribed by 50%. But because they had a contract with the sponsor, the 50% unsold shares were bought by the underwriter at the offer price, and the club was allowed to list on the stock exchange. So there is definitely a risk. Sometimes the risk is inherent because of the business structure, and the gentleman rightly said, privatization versus a private company IPO. Sometimes it is a macroeconomic condition. Something happens, some calamity, some war, something overnight, and suddenly the markets get shut down. And we see that happening the last many weeks now, isn't it? There's something happening on X, a tweet, or whatever you call it these days, and everything then responds in return. And you have no control over it as a company, for example. So you are, at the mercy of market forces in that case. So that is one explanation. Another explanation is more academic. Companies underprice because there are two types of investors who apply for IPO shares: informed and uninformed. Informed investors are big investors, pension funds, insurance companies, hedge funds. They do their research, they're able to distinguish between good and bad quality IPOs. They only apply for good quality IPOs. Uninformed investors are people like you and me. We read the prospectus, we do some research, and we are not able to distinguish between good and bad. So the idea is, when uninformed investors apply for shares, they get allocation in bad quality IPOs, and they suffer a loss. And this happens again and again and again, to the point that people like you and me stop applying for IPO shares completely. And this is something companies and sponsors and regulators don't want. They want different type of people and organizations applying for shares. To keep uninformed investors in the market, companies willingly underprice. Sometimes it is a marketing ploy, that's another explanation. Sometimes it is to create a particular ownership structure of the company. The idea is you underprice lot of demand, you can select as a company whom you want to sell the shares to. So there are multiple explanations why companies sometimes willingly, what we call, leave money on the table. They underprice themselves. And I'm coming to that because I have got something more to talk to you about in terms of the underpricing. Okay? Right, so that was Taliban, which tells us that, something was not right. I don't know why Taliban did not perform so well, but this has happened 4 or 5 months ago. So why are IPOs interesting as an investment opportunity? It is the very first time when people like you and me can be a part of a new exciting firm, a venture, because an IPO is a very important event in the company's life cycle. More importantly, many IPOs provide a profitable investment opportunity for those who want to make quick returns on their investment. So what is that then? Sometimes people call an IPO as an immediate profit opportunity. And how is that? Usually, companies doing an IPO offer shares to new investors at an offer price that is much lower than the traded price on the first day of trading. And this process is called underpricing of IPO shares. And this is not only in UAE or in London, for example, it is a global phenomenon. However, what we see is there are certain periods when underpricing is high and certain periods when it is low. So the level of underpricing changes from one country to the other and from one period to the other. For example, if I take the average between 2022 and 24 in the UAE, the average level of underpricing was about 29%. If I compare this, the annual return on the stock market, for example, the DFM, General Market Index, the return was around 11% for the whole of 2020. So what I'm saying is, by investing in the stock market, at an average, people made around 11%, but in 1 year. Had they invested, and wisely so, in the IPO, they would have made more than twice of that over a period of about 3 weeks or so. So that is the comparison here between the annual return of 11% to the 3-week return of about 29% at an average. And this is how our IPOs have performed from 2022 to 2024. So I calculated the underpricing of these IPOs. Among all the IPOs in the last 3 years, Bayana gave 272% return on its investment on the first day of trading. And then you can see Pure Health was 76%, Admiral was 55%, Diva 15%, so was Dubai Taxi, Burjeel Holdings about the same. Interestingly, there were many firms in the last 3 years where the returns were negative or zero, as you can see here. Yeah. So Lulu Retail, we're talking about, they closed on exactly the same price, which was the offer price on the first day of trading. The return was 0%. Talabat lost you about 7%. Aleph Education lost you about 15% or so of your money.
Do you have to sell immediately at the closing?
I'll come to that, but this is how I end. Give you some information. Okay. So what we learned from this is there's a good chance the price jumps on the first day of trading. There's also a chance that actually it drops. The question is, can you distinguish before you make an application for the IPO shares, which of the companies will see a rise and which will see a fall in the share price on the first day of trading? And that is a difficult question to answer. However, what you could do is, you could do some due diligence. You can read them, you can make up your mind, and you can have an informed decision. So how do you inform yourself is the next thing. By the way, this underpricing in UAE, as I showed you, is not unique. If I look around the world here, starting from Russia all the way to Greece, all these countries show different levels of underpricing, sometimes as low as about 4 or 5%, sometimes as high as about 50% in Greece, for example. Or if you look at other parts of the world, you have a whole range. UAE is shown here. This is a bit dated data. This is basically 10 years ago when we had more than 100% increase in the share price on the first day. China at one point of time was giving more than 100% at an average. It has fallen down to about 40%, but it is a great amount of return for 1 day of trading. So this is a global phenomenon. Levels could be different, as I said. And that brings me to the next part, which is another interesting thing about IPO world. Sometimes IPOs are also called irrationally priced offerings. Why? Remember DIVA with 16% underpricing on the first day, as you rightly were picking up later on. Over the next 3 years, the share price moved from 2.48 to 2.62, which was about 6% increase. But during the same time, the market moved by almost 43%. So when you compare the share price movement of your IPO firm with that of the market in general, the distance between the two will give you if the company has underperformed the market or not. In this case, DIVA has underperformed a large amount. And this is very unusual. Why? I have done a lot of work on privatization IPOs in the UK. So this whole idea of privatization actually started in UK back in 1980s. When Margaret Thatcher came to the government as Prime Minister, she said, yeah, on my agenda is the fact that I want to privatize British gas, British coal, British rail, British nuclear, British telecom. So a number of IPOs came to the market. And what I've seen is, I've followed these IPOs over the last 20, 30 years or so. They have performed exceptionally well because they were privatization IPOs. And you had an explanation that they were backed by the government, so good, perhaps less risk, but they have done very well, historically speaking, in the UK. However, DIVA, and for whatever reason we don't know, has underperformed quite a lot in the last 2.5 years. And this is exactly what has happened. So the purple curve is the share price performance of the stock market in Dubai, and this one, the blue one, is the stock market performance of the business. So it has underperformed over the last 2.5 years or so, maybe 3 years, coming 3 years. Same happened with Pure Health. It gave you 76% return on the first day. If you have not sold shares of Pure Health very early in the trading period, and you held on to these shares for the next couple of years, you'll be there as compared to the market, which is way there. Pure Health has underperformed quite a lot in the last 2 years or so, which is another very interesting story. Why? So that takes us to the next important and interesting thing about IPOs is how do they perform in the long run? If you buy shares in the IPO and you don't sell them immediately, are you better off or are you worse off? And the answer is usually you are worse off. Why? Because in the long run, they don't seem to be good investments. They usually underperform, which is a very interesting fact. Why do IPOs underperform is the next question. So this underperformance can sometimes last up to 5 years after the IPO, and this is coming from research and data around the world. And this underperformance could be anywhere from about 10, 15%, all the way to 50%. For example, here is a set of countries around the world, and you can see how they have underperformed their IPOs. In South America, if I take the largest market, Brazil, you lose about 22% of your investment value within 3 years. If you look at developing economies in India, almost 60% of the investment value is gone within 3 years. UK, US, we're looking at about 12 to 20% down. So the question then is, why is there underperformance? Why shouldn't we be long-term investors? These are average results. Not all companies will go through that. But at an average, this is what is happening around the world. So again, there are many explanations. One important thing is the conflict between the company and the new shareholders after the IPO. This is what we call the principal agent problem. The insiders, the directors, the original shareholders, if they have sold their stake in the IPO, they have lesser incentive to keep on working hard after the IPO. And that starts to show in a conflict between the insiders and new shareholders, reflecting a downward trend in the share price. There's also a technical explanation. In UAE, by law, the sponsor is allowed to artificially support a falling share price, but only for the first 30 days. This is called price support. So when after 30 days, the sponsor removes the price support, the share price starts to go downwards, and then in the long run, the company underperforms. So there are explanations. One simple explanation is a behavioral explanation. We as investors are very excited when an IPO comes to the market. You've got expectations of good performance, but slowly and steadily, we revise our expectation downwards. Oh, this is not as good as we thought it's going to be. And this then starts to reflect in a downward trend on the share price. So what we learned from research is that at an average, in the long run, IPOs don't seem to be good investments. So coming to, yes. So are all the companies initially an IPO? Yes.
So how does the market rise for the IPO?
Exactly. So what we do is, the market is made up of new companies and old companies that have come to the market many years ago, right? So when we compare the new firms with seasoned companies, that is where the difference in performance comes. And that is the reason why we say this is an interesting anomaly in the world. They should be performing like the market, but they don't. And this happens for the first 3 to 5 years after the IPO.
What is the period in which?
3 to 5 years after the IPO.
So
Yeah.
after which it becomes.
There's another fact of the story. Many of the companies that do an IPO don't exist after 5 years. So in my own research on survival of IPOs, what I found was 50% of the companies are gone. So that is another interesting thing, that long-term investment. So when you see all these companies in the market that have existed for 20, 30, 50 years, they are the survivors, because many have not made it. That is another fact about long-term investment in IPOs. Yes.
For day or when you are looking for the returns.
Yes.
We have not considered the returns target space.
Yes. Very good point. When I calculate the returns of Diva, I only look at the share price performance. In fact, the way in which we calculate these long-term returns, it's very technical. We call them buy and hold returns. So there is a mathematical model that we use in order to calculate the returns, because the idea is that Diva will pay you dividends and you reinvest that dividend to buy more shares in the same company. So you reinvest your profits, and therefore there's a compounding effect. That is what we call the buy and hold returns. So this was only to show you the share price, but of course, when you calculate the actual buy and hold, it will be different, but still you will see an underperformance. Salik promised all the profits will be paid out as dividends, and that's what they do. And that would make Salik a good long-term investment, even though Salik's share price, I think it's not dropped, it's actually 5, isn't it? Thereabouts. Sold at 2. Right, and they are trading at 5.15 or something as we speak. So Salik is a very interesting success story of privatization, because they're not only give you an uptake in the share price, Salik has also been paid a lot of dividends. I think they simply paid it twice a year. And all the profits in their declaration, they say we pay them as dividends. So that, for long-term investors, is a great idea. So you are right. What I showed you here are just raw returns, but technically speaking, it will be slightly different, but still you will see underperformance.
In this case, it was the story of COVID only. That people who know the market understand this payment like some huge money in this period.
Yeah.
And the growth perspective, you see that the growth is not there.
And that's what I'm going to come to. How do you distinguish as an investor? How do you figure out this is a growth company or not? We'll come to that in a few minutes. Okay, and then I'll come to you.
Sorry. You showed before the list of the markets that destroyed their value post IPO for 3 years, right? Like from 20 to 30%, whatever.
Yeah.
It's foreign. Those are huge, right? Those markets are huge, and they're liquid.
Yes.
UAE market is not liquid.
Indeed.
No.
We have
Zero liquidity.
no, I think liquidity is there. It's not zero.
If you can see the daily trade is
The turnover is small because the depth of the market is small. It is a fledgling market, right?
investors
Yeah.
right now while you're like showing up.
Yes.
It's mostly like big financial institutions like sovereign wealth funds, etc.
That's right.
So they just retain whatever they're holding.
And this is the pathway markets take from being sort of small markets to established markets like New York, London, Singapore, and Hong Kong.
Based on your research and the knowledge of the market, does it, when it's illiquid, does it destroy more or actually retains more?
Illiquidity is a big issue for everyone involved. Regulators don't like it. Investors don't like it because you cannot sell at the right price. The share price becomes stale. And for that reason, we have rules in stock exchanges that if trading is very thin, the company will be suspended for a period of time. And that would eventually then be kicked out of the stock exchange. So the regulator here is very keen to make sure that the right kind of companies are coming to the market, that people like you and me are partaking in these transactions, that institutions and retail, they all play a part in this. But these are early days. So you have to be a bit more patient, because to reach where London is or Singapore is, it's going to take time. And the regulator wants to do it right, in my opinion. But yes, liquidity is not zero, but it might be low because the depth of the market is small as well as the moment. That would be my answer to that question. Gentlemen, and then you will lady at the back.
What is Malaysia doing differently?
Yeah. Malaysia, be careful about the sample period. This is old sample period. This was before 2000. We don't have much research that tells me exactly what Malaysia is doing right now. But at that point of time, Malaysian IPOs were not underperforming the market. I just kept it to show you that at an average there is underperformance, but sometimes there is overperformance as well. But this is an old sample, and hence, things would have changed quite a lot for Malaysia. This was also the time when a lot of privatizations were happening in Malaysia, and there were issues about the government selling at a cheap price, but companies were good. Maybe that showed up in good long-term performance later on. But I don't have much insight into that. Yeah. Yes.
So, following the line of thinking, like after 3 to 5 years, the share price starts to perform well for companies that have survived. We think about Pure Health,
Yes.
they're backed by Pharma.
Yes.
So do you think after 2 years it would be a good time to invest in Pure Health's share to experience that?
I think, yeah, what I'll say is, if you want to get onto firms like Pure Health right now or in future, it's important that you do some due diligence to see exactly what the plan of the company is for the next 3 to 5 years. You look at their accounts for the last 2 years as well, how they've been performing. Maybe COVID was a good period for Pure Health because it is in that industry, right? COVID now gone, maybe there's streams of income and all of that have dried up. But how they are reinventing themselves, how they are doing innovation, what new stuff is happening within the company, that will give you an idea of what to expect in future. So you start getting some signals, but there is never a guarantee that in Pure Health will have a rebound. Maybe they don't. Maybe they do. I don't have that insight, but it could be, yeah, it's possible. But the thing is, for how long will government sustain a non-performer? That's the question as well. And this has been a big issue for countries where companies are owned by governments, right? So if you look at big economies like India, historically speaking, big firms have been held by the government and they're trying to privatize, but it's not easy. And most of these have been loss-making. So if you look at Air India in the past, hugely loss-making, right? Indian Railways. So converting them into a profitable firm requires a change of almost everything the company stands for. So it's very difficult to put a finger and say, yeah, now's the time to buy because I expect a rebound. But you start getting signals if you start spending time on the company, but slightly over a longer period to get a sense of where the company is going. Yeah.
So I think based on this data, we can buy in the IPO, hold for 30 days, and then short on what.
Yes, I'm not just going to finish with all of that exactly because I'll share with you what I've learned through my own research, how to distinguish between good and bad. So I'm going to answer that question in a few minutes. One last question before we make a start. Okay.
So, thank you very much for your presentation. For the long run underperformance, is there any rule of investor management or investor relations? Strategies they can.
So here we're saying, could long-term performance be an outcome of sort of miscommunication between the company and the market? Absolutely, in my opinion. Corporate communication is extremely important for any company, especially for IPO firms, given this company was not on the radar of people because it was a private firm to start with. Now it is coming to the market, so they have to tell the world we are good, and they have to continue telling the world how they have progressed after the IPO. So I think investor relations plays a very important role. If you ask me, is there any research that says, how does investor relations have an impact on long-term performance? To my knowledge, I don't think there is a paper on it, but that could be an interesting thing. The thing would be, how do you measure it? investor related. How do you quantify them to relate it with the long-term performance? But the idea would be, the more transparent the company is in telling what is happening inside the firm, the more would be, the less anxiety would be there in the market in terms of the true valuation of the company, and that should show in a stable or a rising share price. But there could be a connection, there's a possibility, but to my knowledge, I've not read a paper that has looked at that specifically.
Yes, I'm from China, and so usually I think the IPO, after IPO, the company just finish their job just like that.
Yeah.
The market is just like the stock market is just like go down always, no response anymore. We just waiting for the new IPO.
China is very different. So I have done some research on China as well, and a lot of changes in regulation. Previously, it was a system where companies were not free to decide who's going to do the IPO and when they're going to do an IPO and at what price. As the Chinese government changes this and giving more liberty to companies to do all these decisions, what we have seen is the level of underpricing has come down from 100% to about 40%. So changes are happening, but China is a huge market with a very, very large retail demand. So there'll never be enough IPOs in China to satisfy the demand of small investors. So the stuff that I spoke to you about might be very different when I try to explain Chinese market, because it's on the different end of the spectrum.
Small investor is really hard.
Yeah.
But I think it's very interesting when you look at Chinese companies, they are very undervalued compared to the companies listed in the US market.
Because our money is like 7 times the best they have. Yes.
No, but if you look like, for example, a simple thing like price to earning ratio, if you look here and there, you see like the same industry sales the Chinese companies that are quite low.
Yeah, there are differences, of course, in valuation between countries. In fact, we're going through this in London as well. Many British companies are not doing an IPO on London. They're going to US because they're getting higher valuations there. So valuation is an extremely important part, and unfortunately, we don't have time for that, but I'm very happy to speak to you after the presentation. This is where you as an investor or as a company have to really pay a lot of attention, because this is where all the money is actually. Okay, so what in terms of UAE market this year and beyond, we already had the first IPO in the AEX in 2025. Listed on 11th March, this was last month, 400 million shares sold, price at top of 150, and it's currently trading at about 1.60. And there is also a lot of indication that there's a huge investor appetite for IPOs in UAE as we speak. There was a recent survey in 2024 that shows 84% of UAE investors are likely to invest in future IPOs that are about to take place in UAE. So that gives you a sense, we're talking about oversubscription and not getting enough shares, for example. That could explain, because we are not the only ones watching, there are other people watching as well, and they are applying for shares. So why is that happening? In my opinion, it could be a mix of many reasons. First, currently, as we see, the UAE has economic momentum. And as we were discussing earlier, there is a lot of liquidity here. People are willing to invest. Money is coming in, for sure. The government has also announced, and directly, sometimes indirectly, that they have got long-term privatization plans. So much that is owned by the government is expected to be in the market in the foreseeable future. I was reading a report on Oman that I said that we are planning to have at least 8 or 10 privatization IPOs in the coming months. And that is huge. So it's a large amount in a very small period of time. And the regulator here in UAE has been very proactive, in my opinion. They have picked up and they have developed systems that seem to be transparent, that protect small investors, easy to participate, and so on, because this is something I'll talk about in the next slide or two. The incentive programs to encourage IPOs from private companies. There's a lot of proactive action being taken by the regulators to develop the IPO market in UAE. And this is a report, this is a statement by the CEO of Emirates NBD Capital, who said that we are expecting about 6 to 8 IPOs this year, raising about 10 billion in Emirates this year. And this is the grapevine. These are the companies that might be coming to the market in the coming weeks and months. So, online classified platform, airline, real estate, privatization here in Abu Dhabi, Masdar. So this is the grapevine. Who knows how many of these will make it, or any new will join the bandwagon or not? But it looks like there's a lot of discussion happening around these companies, especially Etihad as an airline. Okay, so let me just
Which is good.
Etihad, yeah,
I think it's the best one.
Okay. Maybe you tell me in a few months when you're writing, you're saying did you invest or not, and how much money you made out of it. But yeah, exactly. I think actually I'm not allowed to invest here as an outsider, but if I were to invest, and this is exactly what I'll tell you how I invest. Everyone should be doing a lot of due diligence, and this is my last part of the presentation. You really choose: is it Etihad or Masdar or Five Holdings?
I think like the only thing is to invest in one, right? Just diversify as much as possible.
So yeah, diversification is one thing, of course, also because of course subscription as well. So the thing is, how do you make up your mind as to where you apply for shares in the West? And this is the last part of what I want to talk to you about. How do you invest in IPOs? What we saw today in the presentation is, at an average, short-term investments in IPOs can give us quite high returns over a short period of time. But if you speak to companies, they actually like long-term investors, right? But if you understand the pricing, as we did today, it might motivate us to sell shares very, very quickly to capture the underpricing. So before you apply for shares in an IPO, it's rational for you to spend some time searching the IPO plan. This should be the starting point for you as a rational investor. And the best place to get your information from, don't go on the chat platforms and so on as how people have made money, and because it could all be, a one-sided story. Go to the IPO prospectus that is freely available, just a download from the website. It's a PDF document usually. And this is the best source of legal information on the company because it is a legal document. It has information on the key details, on investment risks. There's a whole section in the IPO prospectus that tells you why you should not invest in this company. It is the legal requirement to tell what could go wrong. So read that, get a sense, and then ask yourself, am I okay with this kind of risk or not? Because every one of us has different levels of risk appetite. Some of us are risk loving, others are risk averse, some could be risk neutral, right? So get your information on how companies perform, because that is a part of the prospectus. It gives you the last 2 years of audited accounts. So look at the profitability, look at the line items, and you get all the other information from this document. So do your due diligence, read the investment risk section, analyze the financial health of the firm because it is all public knowledge through the IPO prospectus, get a sense of the business model. And this is where we're talking about growth and so on. Is it a company coming from a mature industry? In that case, growth prospects are low. Is it a high growth industry firm? In that case, you would expect a high growth from this one. Read about the dividend policy because it is mentioned in the IPO prospectus. Salik said, we'll pay you all the profits as dividends, which means Salik is telling you, I've got no plans to grow myself because I don't need to, right? So these are the signals you want to catch from the IPO prospectus and then make up your mind if this is somewhere I would like to invest in. Assessing the valuation is a tricky thing, right? If the company says, I will price myself between 3 dirhams and 4.50 dirhams, how do you figure out which is right, which is wrong, this end or that end? For that, you need skills. And for that, you need to come to the University of Manchester and be appreciated for valuation in our MSc Financial Management course or in the MBA course where many of you have been a part of, right? So there's a whole science behind valuation, and I don't expect us, without having that background, to be good valuers, right? But what you could do is, you can compare the offer price with something similar in the same industry. So look at peers, look at same industry, same size, same profitability kind of characteristics, and try to compare with ratios like price to earnings, for example. Evaluate the growth potential from signs like dividend payments or not, for example. What you're looking for is a signal of quality to distinguish a good IPO from not so good IPO. So how do you do that? Things such as top team of advisors. The advisors of the IPO, the most important being the sponsor, it is usually an investment bank. Is it a top quality investment bank? Reputational capital at stake? That could be a signal of quality, for example. Look at, and we were talking about this earlier, if there are cornerstone investors in the companies. Who are cornerstone investors? This is a relatively new phenomenon, which started in Hong Kong actually. So in mid-1990s, Hong Kong IPOs brought in a special type of investor called the cornerstone. These were usually sovereign wealth funds, pension funds, big chunks of money. And they said, here is my $1 million or $5 million. Pricing has not been done. This is my money, I have already invested in your company. Whatever the offer price is, give me the number of shares reflecting the money I'm investing. So these are called cornerstone. And they bring in quality. Why? Because they invest huge amounts of money. They are under obligation not to sell immediately after the IPO. So they are work done, right? And that could be serving as a quality signal because cornerstone do their homework before they invest. And what we found in our own research on Hong Kong, because there's a huge sample size here, cornerstone investor-backed IPOs are better quality IPOs in terms of long-term performance and survival.
Isn't there cornerstone because government pushed up to invest, or just because they really like
It's difficult for me to say. There might be some political forces behind it, but we only observe the actions. What was behind that action is difficult, unless until I was in a meeting to see exactly what the pressure was. It is possible because they invest huge amounts of money in the company, right? And they are long-term investors by contract. So how did they make the decision is an interesting thing. Lock-up agreements are interesting facts about IPOs. So what are lock-up agreements? The original owners of the company, whatever they sell in the IPO, they sell it. What they don't sell, they sometimes voluntarily lock it up for 1 year, maybe 2 years after the IPO. In other words, they're not allowed to sell for a fixed period of time after the IPO. This lock-up agreement is mentioned in the IPO prospectus in a section. So read about it, because that gives you a sense that insiders have got hope and future, and they're well tied up in the future of the company, isn't it? So that could be a good thing for you as a new shareholder in the firm. And of course, we talked about the risk of oversubscription. You apply for X number of shares, you end up getting only a fourth of it, or maybe less than that. This is something we have to live with. So read about the allocation. Currently, what is happening is only a small percentage of companies coming to the UAE IPO market is being sold to small investors, less than 10% usually. So, but this is how it is. It might change in future, but if you want to partake, you have to be content with that there could be an oversubscription and therefore a cut down in the number of shares you have applied for. So here is my understanding of the world of IPOs over a long period of time. It's coming from my own research and what I've read. What I call the 5 summary rules to distinguish good from bad quality IPOs. If you want to profit from this world of IPOs, you should buy your shares at the offer price and sell them very, very quickly on the first day of trading. And when I say very quickly, because on the first day of trading, in the very first hour or so, that is when you see the highest increase in the share price. Okay? So initial trades capture the highest level of underpricing. So if you really want to use this as a strategy, this works quite well in the long run. You know, you buy at offer price and you sell it, not at the end of the first day, which is how we measure the pricing, but very much in the first hour or so you can on the first day of trading. Unless you're buying shares in privatization IPOs, be careful about long-term investment. Why? In my own work, what I've found is quite interesting. Those IPOs that are highly underpriced, if you follow them through for the next 3 to 5 years, they are the ones that really underperform in the long run. So you make a lot of money at the start through underpricing, but if you are a long-term investor, you may end up losing a lot of money. Now, why that happens, it is still a mystery. We're trying to uncover that as we speak. What I also found was interesting. The more profitable a company was before the IPO, the worse is its long-term performance. Again, this is a mystery. Why do good quality firms showing high profits don't perform so well after they've done the IPO? You know, we're just trying to guess what could be the reason in different parts of the world. Rule number 3, IPOs where only secondary shares are being sold, right? Or where insiders are selling a large majority of their stake at the time of the IPO, try to avoid them. But this is not true for UAE. In UAE, almost all the IPOs have got 100% secondary shares, including privatizations, right? So what I'm talking about is the general global result, but it does not really apply, in my opinion, for the UAE IPO. So maybe you can ignore rule 3 if you are interested only in applying for shares in UAE IPOs. Don't sell your shares near the expiry of the lockup agreement, because what we have found is that usually share prices drop around the time of lockup expiry. Why? Because the market preempts, market thinks, oh, on the day of expiry, the market will be flooded by selling shares or the insiders who have been locked up for 1 year or 6 months, right? Actually, yeah, and you see a drop. So as you are closing towards lockup expiry, don't time your sale around that time, because you may end up losing a lot of money if you have to really sell at a lower share price. This is rule 4. Rule 5 is something quite interesting, in my opinion, which is not very visible, but you can infer. What is that? If you don't sell on the first hour of the first day, okay, no problem. Follow the share price for the first month. If you feel the share price is not moving a lot, it is sticky, it could be a signal that your sponsor, the underwriter, is actually artificially supporting a falling share price, right? So this is what is called price stabilization, which is legal. But it is only allowed for the first 30 days after the IPO, even in UAE. So when you read the IPO prospectus in UAE, there will be a section that says the underwriters will conduct price stabilization if need be. But usually, when underwriters are doing the price stabilization, they don't tell the world. They only do it post the event. So how do you infer that? Look at the share price. If it is very close to the offer price or below it, something is going on. Someone is artificially creating a demand to stabilize the price, right? So when sponsors remove the stabilization, the price is expected to fall. In other words, selling towards the end of the first month should be avoided, as this is the time when price stabilization legally stops. So either do it very quickly or avoid lockup expiry or the end of the first month of trading, because these are very important time periods in the life cycle of the IPO. So finally, how do we apply for shares in the UAE? As a retail investor, you need to have what is called NIN, the National Investor Number, an active bank account, and a registered mobile number. Very easy, relatively speaking, to apply for shares. You can do through participating banks, brokerage houses, and even the 2 stock exchanges have their own e-IPO portals that you can just click on, register, and you can buy shares through DFM and ADX. In fact, if you look at the website of the financial market, the DFM, they have a dedicated section on how to subscribe to IPOs. It also has a link which provides you the opportunity to go on the subscription platform straight away, just like that. In ADX, there is also an e-IPO investor portal allowing subscription and IPO. So the regulator has made it very easy for retail investors to apply, just going to no one else, but to the websites of the regulator itself. Then there are a number of digital platforms, such as Emirates NBD has an IPO portal that you can access through the mobile app and even the ATMs for that matter. And there are a number of banks like Maria or Vio or Lifebank, ADCB. For example, Maria helps you to have NIN creation. It helps you to open the account. Getting NIN creation is without any charge. You can get it for free, usually, right?
So NIN creation, let's say for the years.
You can, yes, they will help you with that as well. So it is just going there and you can get all the information you need on the website of these financial intermediaries. Okay? And if you need to see a bit more, for some of you, this is a notebook, for others, my experiences of the world of IPOs, I have summarized them in this book, which is now in the second edition. It's called The Mechanics and Performance of IPOs. So I've tried to be very non-technical. It's like telling you a story from the start to the end, a number of anecdotes, small case studies, explanations for underpricing, long-term performance, how to read a prospectus, and so on and so forth. I've just summarized my own learning throughout my professional life in this book, which I think is available on Amazon here in UAE as well. So you might want to have a look at that. And this is where you can get more information on other parts of the world apart from UAE in terms of the IPO world. So let me just finish by sort of summarizing what I intended to share with you today. In my opinion, as we speak, the UAE's IPO market is quite robust and it is expected to grow in the coming months and years. A really important thing about UAE is the way the regulation is set up. UAE allows people like you and me, which we call retail investors, to participate in an IPO, something that is not existing in markets like London at all. In London, 99% of the IPOs don't allow retail investors to apply. Only institutions can, which is really surprising, but this is how it is. Whereas almost all IPOs that we have seen today, they have a retail tranche, which means you have the opportunity to participate in the IPO process. Making informed decisions by reading the documents like prospectus is extremely important. So don't just be a punter in the sense, I'm going to close my eyes and I'm going to push the button. Read, make an informed decision. And knowledge gives you that power. So do your research as much as you can. Monitor the upcoming IPOs. A lot of information is made public through the stock exchange websites or platforms. They'll give you a list of what is coming into the market and conduct thorough research before you make up your mind to invest. I think this is all that I wanted to cover with you. Thank you all for your information and your contribution. Very happy to take any questions before we come to an end.
Yeah, I ask a question. Like, I'm doing the AI devices now.
Yeah.
And, I don't know when I need to like thinking about the VC side and also like the IPO. When is the time to think about that?
Yeah. So I think the conversation in the company starts by the fact when you look at your next 3 to 5 years of plan, which every company should have, and then you look at these are my plans and what will arrive, what will take me to that plan that I have in my mind. Of course, it will be capital. So you would need to know what would be the need of capital for your firm, for whatever you want to do, innovation or selling, whatever it is. So you have this in mind. Do you have the capital to reach the goal that you have set for your company? If you would like to answer that question, IPO could be the answer. It is not the only answer, but it could be the answer. Coming to venture capital, VCs usually invest at the early stage of the venture. So, as you were explaining to me before the presentation, that looks like you're pretty much on the early stages, right? This could be the time when you want to speak to venture capitalists. And now it is slightly easier because there are venture capital associations, and you can sort of do a pitch, for example. At Manchester, we have an incubation center for businesses, which is where we bring a new venture and a potential VC together, so that you can talk to them and you say if they're interested and all. We actually teach venture capital and private equity in our global MBA program and our MSc Financial Management. How do you make a deal? How do you value a firm? How do you interact with the VCs? So you get to speak to real venture capitalists in that case.
So you need to
Do so, because it's a very important part in the life stage of your firm, especially when you're growing your firm. IPO comes after venture capital. So VC would be the first port of call, in my opinion. VCs will then tell you when you are ready as a company to do the IPO, because VCs exit companies by selling shares at the time of the IPO.
So, like the revenue, I think all large in value, the revenue, then you get thinking about IPO things.
I think it's a case-by-case basis. Small companies do an IPO, Large companies do an IPO, young firms do an IPO. At the height of the dot-com bubble, companies were set up only 6 months ago, and they did the IPO, very successful ones. Yeah. The average age of a technical company was less than 2 years in London, back in 1999, 2000, which was the height of the dot-com bubble. But then you have companies with an average age of 15 years before they do the IPO. Right? So it all depends, you know, the industry, especially yours is high tech. It might be that going early gives you the capital for you to thrive and grow and survive in the long run.
Also, like it's really competition loss.
Oh yeah, exactly. So every industry and different stages of life cycle would be looked at differently. It's a case by case basis. All right.
Single question. Like, you see, like, the capital market is trying to, cost of debt is super high, right? And trying to say, like, the Fed rate was probably would be decreased, which potentially can slightly decrease the cost of capital. When the cost of capital is very high,
Yeah.
the equity should be super cheap, right? So why the, like, upcoming unusual diesel, right?
Yeah.
But it should be like, you know, like, I'm expecting the price would be lower than would be potentially they can get, because there are like other potential opportunities to invest like with that.
Okay, so but let me take the first question first, cost of capital. Cost of capital is made up of two parts, cost of debt and cost of equity. As a company, you want to have the lowest possible cost of capital because then the value of the company is the highest, right? So if debt is becoming costlier, so does the equity.
No, as an investor,
Yes.
as an investor, is
To basically stock markets and bond markets.
yes, giving me better, like, you know, like earnings. So why I should, like, my expectation for equity should be like, it should be way cheaper for me, right?
Okay. And this is where we talk about the depths in the market. There are people who believe like you do, there are people who believe the opposite as well.
Trump said it like,
Trump says there's so many things, and then the next morning it's the opposite. But you're right, something interesting is happening.
right?
Yeah.
Like, AAA, like, can get here, I think, like, from 5 to 6 to even 7% down late, which is like very expensive.
Very expensive, yeah.
Never heard that, like,
Yeah.
it was used to be 2%.
What happens around the world in steady times is when the stock markets are going down, bond markets usually rise. Why? Because people withdraw money from the stock market, but they need to park it somewhere that is less risky. And that's exactly what we saw at the height of the global financial crisis. But something interesting is happening in the last couple of months. Both the stock markets and debt markets are falling at the same time. So the economists are worried, how can this happen, right? And this is because the debt overhang and the level of debt in major economies like the US have. And they are basically rubbing the wrong shoulders as well, which means all those who hold debt, China is one of the largest holders of US governmental debt, and they are really, you know, sort of not seeing eye to eye, isn't it? So it's an interesting time, but I think it's early. If you ask me what my view is, I'm as perplexed as everyone else is because of the uncertainty. Uncertainty brings in risk. And then risk then brings in different expectations of returns, either on the bond market or on the stock market. Right now, a lot of volatility because we don't know how everything will settle. Today is what, the 95th day of the first 100 days of presidency or something like that. And usually the first 100 days are important. So give another 5 days and hopefully things will start to cool down. But right now, very difficult.
Yesterday, Dow Jones and
They went up.
500, they rebounded.
Yeah, they did. Yeah.
Quite huge, actually.
Yeah.
Quite very good. Like,
Yeah.
so
Yeah.
I don't think like crypto increase, right? So I'm investing in gold.
Gold is doing very well. Yeah. So, and you are sitting in the right place. You are in one of the best gold markets. And actually, I have great respect for my mothers and grandmothers who invested all their money in gold jewelry. I'm from India, by the way. So much of the wealth of the household is in gold jewelry. They are the best investors in the long run, aren't they? Because without knowing what the gold will be doing, you see where the gold is as we currently speak. Because you need a fallback. If bond markets are not giving you a return, if the stock market is not giving you a return, who will? It's the gold, right? So a lot of people are thinking about precious metals as we speak, but even another month, who knows where we will be. So right now, maybe it's time to sit tight, how things pan out, and hopefully you get to see a pathway in the coming months. But it has to settle one way or the other. It cannot, it's unsustainable the way we are currently.
What is your view on the, sorry, on the data centers and the, you know, like this, how do you call it, like something like BioLab, right, in US that provides this cooling, like big, I don't know, like, how do you call it, data houses?
Okay.
Like Amazon.
I have read about it, but unfortunately I have no expertise on this. Yeah, but I know they conserve, they take a lot of energy and they need cooling systems and all, but I have no view, unfortunately.
Because like AI currently and this crypto, right?
Yeah.
They use so much energy,
They
right?
do. Yeah. So this is the downside of crypto, isn't it? Is all the energy, the carbon footprint it leaves, for example. And this is what my professors back, who are looking at ESG and so on, making money at what cost? So maybe another masterclass on that, right? Okay. Anyone? Any other question? Yes.
Yes. One or two observations. When uncertainty is there is a very chance to get money.
Yeah, true.
That's how they give you opportunity. And I believe this market, US market, will boom like that. Somebody putting in money right now, will make money.
The expectation is that the stock market in the US, this is in the top banks, will grow by 2% by the end of 2025, which means, first of all, they have to make up the lost 15% plus another 2 on top of that. And that would be the rebound we're expecting in the next sort of 6-7 months or so. Let's see, let's hope that it makes.
In my what I experience, IPO we talk about a lot. It's mostly mostly underperform. If any IPO is talking about a like everybody want to put money,
Yeah.
mostly every chance of money.
Underperformance is wrong.
But I see
Yeah.
Next question for you. Do we have any criteria that any IPO for being applying it must be profitable or not?
Usually, regulations ask for a company.
India,
Yeah.
loss-making companies are not like it.
Yes, that's what I'm saying. So there are regulations in some countries where loss-making companies cannot come to the IPO world anyways, right? So you will expect successful IPOs to have profits in the past. But research, not only India, but in other markets, in my own research, I've seen that more profitable firms before the IPO show a lot of underperformance in the long run. If you ask me why that is the case, I don't know the answer, but that is what the data is telling me. No, the idea is IPO should be giving you that flip where you have refinanced the company because you have plans for future, and IPO gives you the capital to achieve those plans.
More important the future plan. Always.
It is.
The scalability is how much is there, how much you can afford to access and it is structured.
Absolutely.
Then having higher opportunity.
Sure, absolutely. I agree on that. Okay. Any last question before we stop? Yes, please. My pleasure.
Not trying to do it this way.
Okay.
But I was interested in knowing more expenses. It's the first time for me to hear about the IPO.
Right, okay.
And at the same time, I felt like I was able to understand based on.
I'm pleased to hear that.
It's very different. It's really peaceful as well.
Thank you.
And the masterclass actually.
Yeah.
And I used to have one question. Talking about why they have to cycle in the first thing hours. So how does this work? Like, is the price going to change in these 3 hours? Like, how will I benefit from that?
Yes. So what happens is, if you buy the shares in the IPO firm at the offer price, which is what you will do, at an average, what happens is, on the first day, when the company starts trading on the stock exchange, for good quality IPOs, you would see a jump in the price. This jump happens very early in the morning hours of the first trading day. And then there's ups and downs through the day, and then it closes at a particular price. Right? So what I'm saying is, data suggests that if you want to sell on the first day, you should be selling very early on the first day, because that's when you can capture a huge jump in the share price. So that would be the point of focus in terms of those who want to sell very, very quickly, maybe on the first day of trading. Within the first day, the first hour is extremely important. That's what I want to say.
So there will be a difference.
Yeah, it is possible that there is a drop. It is also possible there is a huge jump, right? As I showed you with some examples here. If you're lucky and there is a huge jump, very likely it happens in the first 60 minutes, 90 minutes when the stock market starts trading. Yeah. Yeah. These days you have got data platforms that give you almost, continuous share price, updated every 30 minutes, every hour or so. There are third many companies who do this. Absolutely, yes. Okay. Okay, everyone, so thank you very much. It was a pleasure for me to be here. Robert, we have a few minutes to stay back.
Yes.
I'm happy to meet you and have very unofficial chat if you want. If anyone has any questions about the programs that Ronald was talking about, our part-time MSc is very happy to speak to you about that as well. So feel free to come and join me, and I'm happy to interact if you have time.
Yeah, thank you very much, Dr. Arif, and all the applause for Dr. Arif. So, I would like to invite you as well in our upcoming events, especially this coming May. So we have our program director from UK, our MBA program director will be in town, Mr. Xavier Delon. He will be delivering an MBA program in Dubai on May 1st, that is Thursday, next week. And he will be traveling, those who are traveling to Saudi Arabia, especially in Riyadh. He will be delivering a public masterclass about strategy and interdependence, STC Academy in Riyadh on May 4th, which is Sunday. Okay. Also, I would like to invite you to follow us all on our social media platforms from YouTube, Facebook, from X, and give us a good review as well to continue to give you a better service and improve or give us some more suggestions about topics that you want us to deliver, especially to all of you. And I would like to thank all of you as well, especially acknowledge the presence. I was supposed to acknowledge you at the beginning, but all our students and alumni who are based here in Abu Dhabi, thank you for always attending and supporting our events here in Abu Dhabi, and to all our guests who are interested in any of our programs that we offer in Dubai. We will still be here for a few minutes. We will still have some food outside. So once again, thank you. Drive safe, and we will see you all again. Thank you.